What is margin? Margin is the amount of money you need in your account so you can open a trade. The easiest way to think of it is like a deposit that's held by a broker. Just like renting a house, you put down a deposit, and if there's no damage at the end of the lease, you get your deposit back. It's the same in trading. When you close your position, the margin is returned to your account. So how do you calculate margin? The margin you need depends on your leverage. The higher the leverage, the lower the margin. For most trading products, you use this simple formula. Margin equals trade size divided by leverage. Before we go on, it's important to know that margin is always calculated in what's called a quote currency, and trade size is always in base currency. For example, if you trade in Euro USD, Euro would be your base currency and USD your quote currency. In this situation, you're technically trading euros for a certain amount of dollars. Okay, so back to margin. Let's say you have a trading account with $1,000 in it, and you're using a 1 to 100 leverage. Your $1,000 capital multiplied by 1 to 100 leverage means you could open positions worth $100,000. But how much margin would you need to open a position? Let's say you want to trade 0.1 lot of Euro USD with a trade size of 10,000 euro. That's 0.1 times by 100,000, which is the standard contract size for most Forex currency pairs. In this case, your required margin would be your trade size. That's 10,000 euro, divided by the leverage, which is 100. That equals 100 euro. But remember that the margin is calculated in the quote currency, which in our example is USD. Let's assume the current Euro USD price is 1.00831. That means the required margin is 100.83 USD. If this still seems a bit confusing, don't worry, because margin is automatically calculated in your trading platform. But it's always good to understand how these things work. And while we're learning important concepts, let's look at some of the hidden dangers of trading. Their names are margin call and stop out. A margin call is where the account equity falls below what the broker needs to keep the trade open. Basically, it means you're losing money, and there's not enough left in the account to keep the trade open. If that happens, the trader has to put more money into the trading account to keep the positions open. If the margin isn't increased in time, you might get stopped out. A stop out is when the margin level falls below the required amount and your trading positions are closed automatically. This is bad news. To avoid a margin call or a stop out, it's critical to consider your margin level before you open any other trades. The margin level tells you how much of your funds are available for new trades. The higher the margin level, the higher the free margin you'll have available for trading. Want to know how to calculate the margin? Simple. Equity divided by use margin times 100. And just remember that margin is displayed as a percentage figure. For example, if your equity is $100,000 and you've used $5,000 as margin, your margin level would be 1,000 divided by 5,000 times by 100. That's equal to 200%. Because margin and leverage are some of the most important concepts in trading, and your long-term success as a trader depends on getting them right, it's worth taking your time to understand how they work, and especially how they work for you.